Good afternoon and welcome to the deep dive. Thank you for joining us. We are really getting into one of the most, psychologically complex trading days we've seen this year. Thursday, October 30, 2025.
That's right.
This was the day U.S. equities just pulled back sharply from those record highs we'd just hit. It signaled a pretty profound and honestly immediate shift in market thinking.
Yeah, it felt like a switch flipped.
It really did. It was the day the market, which, had been absolutely soaring on this AI euphoria, suddenly slammed on the brakes. It almost felt like it started fearing its own success.
It was fascinating, wasn't it? A real moment of contradiction. Yeah. We saw all that optimism turn deeply cautious almost within a single trading session.
Yeah.
So our mission today really is to get past the simple headlines and unpack the specific kind of conflicting catalysts that all crashed together on Thursday. Why did they shatter market conviction like that?
We're diving into why a record-setting week suddenly pivoted into a major risk-off day.
Exactly. Why the fear?
Absolutely. And when you look across the stack of sources, the analyst notes, the earnings transcripts, you quickly realize this wasn't just like simple profit taking.
No, far from it.
This was a convergence.
Yep.
Three huge gravitational forces all pushing down on stocks at the same time, creating what we're calling a market cost fracture.
And we can really structure this deep dive around those three pillars of volatility. First, you had the big macro anchor, that hawkish hangover from the Federal Reserve. They actively pushed back against the market, hoping for easy money.
Okay, pillar one.
Pillar two, maybe the most fundamental split. The whole Magnificent Seven story, the big tech narrative, it fractured right open. Fears about AI spending costs versus actual AI monetization.
The cost versus the payoff, got it.
And then third, kind of humming in the background, amplifying everything, was a serious U.S. government data blackout because of the shutdown. That just made every bit of negative corporate news feel 10 times worse.
Right, uncertainty on top of uncertainty. And the immediate numbers, they really told the story, didn't they? It was like a targeted strike on growth and tech. The selling was incredibly discriminatory.
You saw it right there in the index performance.
Yeah, the blue chip Dow Jones Industrial Average, it showed surprising strength, really. Only lost a modest 0.2%.
Held up relatively well.
But the pain was absolutely concentrated in those tech-focused names. The S&P 500 fell a solid 1%. But the tech-heavy NASDAQ composite, that really led the charge downward, dropping a pronounced 1.6%. Just a violent pullback from the all-time high it set, the day before?
Really the day before. So this was clearly a tech-centric anxiety session, no question.
Okay, let's unpack this then, starting with that gravitational pull from the macro environment. Because, before we even dive into the sort of terrifying earnings guidance from Meta and Microsoft later in the day, the Fed had already kind of poisoned the well, right? Set a negative tone.
Absolutely. That macro backdrop was key.
So help us dissect this hawkish hangover.
Well, the initial action itself, the rate cut, that was fully baked in. The Federal Open Market Committee, the FOMC, they delivered the expected 25 basis point cut. That brought the federal funds rate down to that 3.75% to 4% range.
Right, markets saw that coming. Over 90% certainty priced in.
Totally expected. The trouble, the real shock, started not with the cut itself, but with the words that came with it. Chair Jerome Powell's press conference.
Okay, so the sources say Powell rattled markets here. He pushed back hard against the assumption that, the rate cuts were just going to keep coming through the end of the year. What exactly did he say that caused such an immediate and aggressive recalibration in the markets?
He was pretty emphatic. He stated that an additional interest rate cut in December is not a foregone conclusion. Far from it. That phrase, far from it, really landed heavily.
Not just hedging them.
No, he was actively rejecting the market's pricing of near certainty. And he even mentioned there was, quote, spirited debate and strongly differing views about how to proceed inside the Fed meeting.
Oh, interesting. So not a unified front.
Not at all. And that just threw ice-cold water on the idea that the Fed was ready to ease financial conditions aggressively into year-end. You have to remember, this statement landed in a market that had just hit record highs, partly because it was betting on exactly that looser policy, lower rates coming soon.
So he essentially just pulled the rug out from under that whole easy money narrative that was driving things.
Pretty much, yeah.
And that immediately ripples through the bond market, right? Tightening financial conditions, even though they just delivered a small cut.
Precisely. It's not just about the cost of borrowing today. It's about expectations for the future cost of borrowing. And that's priced into the long end of the yield curve. Powell's hawkish tone immediately sent the benchmark 10-year Treasury yield surging. It settled at 4.09% at the close.
Right, extending that move back above that critical 4% level we'd been watching.
That 4% level is psychologically huge.
Okay, so for our listener who might be a bit newer to this, can you quickly connect those dots for us? Why is a 4.09% 10-year yield, which, sounds like a modest tick up, why does that feel like a sledgehammer hitting the NASDAQ, which is so dominated by high-growth tech?
Yeah, it's a great question. The key concept is duration risk. It really relates to how you value these high-growth stocks using the discounted cash flow model, or DCF.
Okay.
When analysts value a company like, say, Meta or Microsoft, they're making big bets on huge profits way out in the future, 5, 7, maybe 10 years down the road.
Right, the payoff is later.
Exactly. And those distant future profits have to be discounted back to what they're worth today. And the interest rate used for that discount calculation is heavily influenced by the 10-year Treasury yield. So when that yield goes up, especially crossing that 4% threshold,
This discount rate goes up too.
significantly, which means the present value of those far-off hypothetical future cash flows, it shrinks dramatically. Higher discount rates automatically squash the multiples, the price-to-earnings ratios that the market is willing to pay for growth stocks.
Yeah.
It doesn't matter how well they did this quarter, the future looks less valuable today. It just reduces the appeal of anything that's long-duration growth.
So this tightening of financial conditions, this gravitational pull, as you called it, set the negative mood music for the whole day. Made investors jumpy about any hint of future risk.
Exactly. Hypersensitive. And you saw that reinforced in the currency market too, right? The dollar got stronger.
Yeah, classic sign. Money flowing back to perceived safety in U.S. assets because the odds of more rate cuts and therefore a weaker dollar just went down.
Correct. The U.S. dollar index, the DXY, measures the dollar against other major currencies. It charged up to monthly highs, advanced 0.3% to 99.54. Tighter conditions at home, thanks to a hawkish Fed, increased the cost of capital everywhere and just dampened the appetite for riskier assets, especially those high multiple stocks that really need cheap money to justify their valuations.
Okay, shifting gears slightly, but still on the macro picture, there was also that major U.S.-China summit happening around the same time. It tried maybe to offer a bullish counter-narrative, but it sounds like it basically failed.
Yeah, it fizzled out as a market catalyst. President Trump met with Chinese leader Xi Jinping in Busan, South Korea. And, the headlines looked okay on paper. Trump called the talks at 12, announced plans to cut some tariffs.
And China responded.
China agreed to ease up on rare earth exports, promised very strong action on fentanyl chemicals. I mean, these aren't trivial things. They're positive developments.
So why didn't that inject any confidence? The market was clearly desperate for some good news.
Because the market had already run up to those record highs earlier in the week, anticipating some kind of grand bargain, expectations were just massive.
Priced in already.
Completely priced in. The analyst consensus pretty quickly dismissed the actual outcome. They called the results fine, but fine isn't good enough given the expectations. Another quote was, small gestures instead of a grand bargain.
So, not enough juice.
Not nearly enough. Since the market had already factored in this minor positive development, it just failed completely to provide a fresh, bullish reason to buy. It couldn't offset the heavy downward pull from the Fed's hawkish stance. The market basically shrugged and went right back to trading on the more powerful, immediate negative. Tighter money is coming, or at least not getting looser anytime soon.
Okay, so we've established the macro scene. The Fed, the bond market, already actively working against growth stocks before we even get to the corporate earnings. Now let's see what happened when that corporate data hit this negative backdrop. And this is where it gets really fascinating, because that monolithic AI trade, the one that drove the market for, 2 years?
At least.
It fractured right down the middle on Thursday. The market suddenly started discriminating, violently, between AI spending and actual AI monetization.
This was absolutely the end of the just buy everything AI idea. Fundamentally, it became a show me the money moment. Investors suddenly woke up to the fact that building this next generation of AI infrastructure, it's an arms race, and it requires just astronomical amounts of upfront capital expenditure, CapEx.
Right.
And the market was just no longer willing to write these companies blank checks for that spending without a really crystal clear timeline for the return on investment, especially, with the cost of capital going up thanks to the Fed.
Okay, let's look at the spend narrative first. The companies that got hammered by the fear that AI is this massive margin-crushing arms race. We have to start with the heaviest weight on the S&P 500. Meta platforms. I mean, that drop was truly catastrophic.
Meta was absolutely the lightning rod for the whole session's fear. Its shares plunged a staggering 11.3% on Thursday, just wiped out billions in market cap.
And the crazy part is, their actual reported results for Q3 weren't even bad, right?
No, they were solid. They met or beat most expectations. The drop was purely about the future guidance, specifically the capital they said they needed to build out their AI vision. Investors were, and this is a quote, perturbed by how much Facebook's parent company said it's planning to spend in 2026.
2026. So the punishment wasn't even for current performance or next year's spending, but for spending that won't even peak for over a year. Doesn't an 11% plunge seem like a massive overreaction to a multi-year CapEx cycle?
Well, it reflects panic over the timeline and the sheer scale of it.
Yeah.
The fear isn't just the cost of the servers and the specialized chips, which is huge, but it's also R&D, hiring the right talent to build competitive large language models. It's the whole ecosystem.
Okay.
By signaling an increased CapEx cycle stretching way out into 2026, Meta basically implied that the payoff, the ROI for this massive spending, is still really far out on the horizon.
And combine that distant payoff with the rising discount rate we talked about from the hawkish Fed.
Exactly. The current valuation suddenly looks unsustainable to a lot of people. It's the uncertainty of that payoff timeline that really spooked the market and triggered the sell-off.
And Microsoft followed suit, although maybe less severely. Despite reporting stronger than expected profit and revenue, MSFT shares still sank about 3%. The concerns mirrored Meta exactly, didn't they?
They did, largely. Microsoft's case was maybe a bit more nuanced because, they already have a huge mature monetization engine with Azure Cloud. But the fears were sort of twofold there. First, maybe growth in Azure fell just slightly short of the incredibly high expectations Wall Street had set, perhaps signaling some short-term softness in companies adopting cloud services.
Okay, slight miss on Azure growth. And second, the spending signal again.
Exactly the same signal. Like Meta, Microsoft indicated it expects to spend more on investments in 2026 than in 2025. Boom, that just confirmed the market's worst fear. This CapEx cycle isn't stabilizing, it's accelerating. The drain on free cash flow is going to continue for longer than people thought. Analysts are worried about margins getting eaten up by this constant need to buy the latest AI infrastructure like NVIDIA's high-end chips, which are incredibly expensive and, frankly, become obsolete pretty quickly in this AI arms race.
So the market realized it had maybe underestimated the sheer cost of just staying competitive at the cutting edge of AI?
Massively underestimated the cost of entry and, maybe more importantly, the cost of maintenance.
But crucially, the AI narrative didn't completely collapse because we had a clear, powerful counterpoint. A company that provided proof that all this spending can actually pay off. Alphabet. This is the monetized narrative winner.
Alphabet was the absolute definitive counterpoint. It showed the essential difference between just spending for future capabilities and actually delivering profits today. Their shares rose robustly. The range was between 2.5 and 5.3%, hitting a new record high. They absolutely thrilled Wall Street, as one report put it, by crossing that landmark milestone, over $100 billion in quarterly revenue for the first time ever.
Wow. 100 billion.
Yeah, it just showed execution at an immense scale.
And the key driver for that excitement, the part that relates directly to AI, was their cloud division, right? Which should benefit from all the CapEx we were just talking about.
Precisely. Google Cloud reported really strong revenue growth. It's benefiting directly from, quote, surging enterprise demand for AI-powered infrastructure and data analytics services. This is the pivot point for the whole market's thinking on Thursday.
Okay.
Alphabet delivered tangible, record-breaking proof of AI monetization happening at scale right now. It validated its own history of CapEx. So while Meta and Microsoft guidance triggered fears about an uncertain payoff timeline way down the road,
Alphabet showed the money was already coming in.
Exactly. Alphabet showed the market where the money is actually flowing right now. That divergence is the absolute defining characteristic of October 30th. The market is now aggressively, maybe ruthlessly, distinguishing between those just building the AI future and those already ringing the cash register from it.
And just to show that this anxiety wasn't purely confined to the mega-cap tech giants, this sort of sector rotation and nervousness spilled over, we got a pretty stark warning sign from the consumer sector too, right?
Oh, we certainly did. A major consumer health warning came via Chipotle Mexican Grill, CMG. Their shares crashed. It was an alarming 17 to 18% drop.
Whoa. Why?
They trimmed their sales growth forecast. And the reason they gave was telling. Persistent macroeconomic pressures and specifically customers making fewer visits.
Fewer visits. Okay, that's direct.
That implies the average consumer, maybe the middle-class consumer, is starting to pull back on discretionary spending, eating out less often. It's a direct red flag that those tight financial conditions, the sticky inflation, it's finally hitting people's daily behavior.
But mirroring that split we saw in tech, we also had sectors showing immense strength, proving that capital wasn't just fleeing the market entirely, it was just rotating violently towards perceived safety and immediate results.
Yeah, healthcare was a major bright spot. It often acts as a defensive sector when uncertainty spikes. Eli Lilly shares rose between 1.7 and 4%.
On the back of those blockbuster drugs.
Exactly. Huge sales for their diabetes and obesity drugs, Mounjaro and Zepbound. These things are delivering immediate, massive, and highly predictable revenue streams. That let Lilly lift its full-year guidance confidently.
Nice.
And we saw others, too. Pre-market reporters like Bristol-Myers Squibb, Alnylam, they also raised their revenue guidance for the next year. So yeah, the market was sorting winners and losers with extreme prejudice, punishing uncertainty, rewarding immediate, profitable, and, frankly, defensive growth.
Okay, it's really crucial now to connect that intense corporate anxiety, that violent sector rotation we just laid out, back to the bigger macro uncertainty. Because that third pillar you mentioned, the U.S. government shutdown, acted as this massive volatility amplifier, created what the sources called a data blackout.
Yeah, this is just a textbook example of how a lack of information breeds fear and volatility in markets. The U.S. government shutdown hit its 30th day. That meant financial institutions, policymakers like the Fed, investors, everyone was operating in a significant data vacuum.
Right.
In finance, volatility is often just a function of uncertainty. And nothing increases uncertainty like the complete absence of objective data, of the official truth.
And the most critical casualty, data-wise, on October 30th itself was the scheduled release of the third quarter GDP figures, right? The big one.
Indefinitely postponed.
Yeah.
That just deepened this federal data blackout, which had already delayed key reports on employment, on trade, on retail sales. The consequence is really profound. Investors are truly flying blind.
Flying blind.
You have no official objective data to confirm the economy's actual trajectory. Is it slowing down like the Fed wants? Is it speeding up? Is it just stagnating? We don't know from the official numbers. And the Fed itself, the market's main focus, is also deprived of its key inputs for making decisions.
And when you're flying blind, the risk premium just goes way up. You demand more compensation for taking risk, which usually means selling first and asking questions later. But what does this data void practically do to analysts and traders day to day?
Well, it acts as that volatility amplifier in two really critical ways. First, it forces everyone to rely much more heavily on subjective, private sector data. Since you can't get the official government employment or retail sales figures, you place an outsized weight on the corporate guidance that is available.
Ah, okay. That explains why the guidance from Meta and Microsoft, those forward-looking statements, had such a punishing, market-moving impact.
Exactly. If you can't trust the government's numbers because they don't exist right now, you desperately cling to the earnings call transcripts of the big tech leaders. You elevate their corporate forecasts to the status of, like, de facto economic indicators.
Which is incredibly risky, right? Because corporate guidance is designed to manage expectations and serve corporate goals, not provide totally objective economic truth.
Precisely. And that reliance introduces significant systemic risk. When the market is forced to prioritize the narratives spun by tech giants over objective macro data, it kind of loses its grounding. It's like if the official thermometer is broken, you start guessing the economic temperature based on how companies say they feel.
Yeah.
It just forces investors into a much more risk-averse stance.
Okay, that's the first way it amplifies risk. What's the second?
It makes the market hypersensitive to the few reports that are still scheduled for release. In this case, the ones coming out the next day, Friday. Since any single piece of data is now treated as this immense indicator of the whole economic picture.
Right, because it's all you've got.
All you've got. So this dynamic meant that the handful of reports scheduled for Friday morning suddenly held massively magnified importance. It set the stage for a potentially really volatile section. The fog of uncertainty makes every little piece of actionable data potentially explosive. It's like, driving a car in really heavy fog. You slow way down, you increase the distance between you and the car ahead, and every single brake light you see feels like a major emergency.
So we ended the regular trading session deep in the red, battered by the Fed, battered by this AI cost fracture, just bracing for more volatility. But then the extended session, after hours, delivered a pretty powerful bullish rebuttal, didn't it? Particularly from Amazon. But it was surprisingly kind of muted or ignored by the market. That highlights a real disconnect.
Yeah, Amazon's report, released right after the closing bell, should have been the perfect counter-narrative to those AI cost fears that
Yeah.
had dominated the entire day. They didn't just beat estimates, they really demolished them. Delivered a strong statement about the health of the consumer and the accelerating demand for cloud infrastructure.
What were the number?
They beat on both top and bottom lines. Net sales were up 13% year over year to a massive $180.2 billion. And EPS came in strong at $1.95 per share.
Okay, strong headline numbers. But the real story, the critical data point that really should have calmed those AI spending fears, was the performance of Amazon Web Services, AWS, right? If Meta scared the market with cost, Amazon should have thrilled them with AWS profit.
AWS delivered unequivocally strong results. Segment sales grew a significant 20% year over year, and it generated $11.4 billion in operating income just from AWS.
20% growth, that's huge.
It's not just a high number. CEO Andy Jassy specifically confirmed that this 20% rate represented a crucial reacceleration of growth. He said it was a pace not seen since 2022. That's hard proof that strong enterprise demand for AI and core cloud infrastructure is robust and immediately profitable.
Okay, that is a direct, tangible validation of the entire AI monetization thesis that Alphabet hinted at earlier. Amazon proved the demand for that infrastructure is accelerating, it's profitable, it's generating billions right now. So why was the market so unimpressed? Why didn't AMZN stock soar after hours?
That's the disconnect. That really defined the end of the trading day and into the night. Despite this incredibly powerful validation of the AI investment cycle, confirming really strong fundamentals, AMZN shares were actually muted in after-hours trading. They were down slightly, like minus 0.22% last I checked.
Wow.
It really suggests that the pervasive negative sentiment, that combination of the hawkish Fed and the really deep-seated AI cost fear, was just too strong. Too entrenched to be immediately overcome by even stellar stock-specific fundamentals from a giant like Amazon. Investors were prioritizing the systemic risk, the macro risk from the Fed and rising rates, over the success of any single company, even one firing on all cylinders like Amazon. The macro fear was just overpowering the micro reality.
Meanwhile, Apple, the final Magnificent Seven member to report, also came out after the bell. The full analysis wasn't out yet, but the initial market reaction looked more positive, suggesting maybe less drastic guidance than Meta gave.
Yeah, Apple was trading positively in after hours, up about 0.77%. Investors were obviously watching intently, scrutinizing a few key things. Early sales data for the new flagship iPhone 17 cycle, the continued reliable growth of its super high-margin services business, which is expected to cross $100 billion in annual revenue soon. That offers predictable cash flows the market loves right now.
Predictability is king.
Absolutely. And critically, investors were laser-focused on any commentary, any hint about Apple's own AI spending plans, especially after the Meta and Microsoft rout. Apple's traditionally more secretive about its next-gen CapEx plans, so the market was holding its breath. But the initial read suggested they hadn't delivered the same kind of CapEx spending shock guidance that Meta did.
Okay, so even with Alphabet confirming monetization, Amazon confirming accelerating and profitable infrastructure demand, and Apple seemingly avoiding a spending scare, the overall futures market sentiment was still overwhelmingly bearish heading into Friday's session.
Absolutely. The NASDAQ 100 futures were pointing sharply lower, down about 1.03% for Friday's open. It just confirms that the negative narrative, the Fed hawkishness, the deep-seated AI cost fears was still dominating everything else. The market positioned defensively, basically assuming that rotation out of tech and growth would just continue until the next piece of objective data could maybe provide some relief.
And that relief, or potentially further pain, depended entirely on that high-stakes 8:30 a.m. Eastern data dump on Friday morning. The shutdown showdown, as you called it. Because of the data blackout, these few remaining reports held extreme magnified importance.
They were suddenly the primary determinants of the market's direction. They would effectively decide whether Powell's hawkish warning from Wednesday was justified or maybe overblown. We're talking about two really critical inflation-sensitive reports that the Fed watches like a hawk.
Okay, what were they?
First, the core PCE price index. That's the Personal Consumption Expenditures Price Index, excluding food and energy. It's the Fed's preferred inflation gauge because it adjusts for how consumers change their buying habits when prices change. It gives, arguably, a cleaner read on underlying price pressures than the more commonly cited CPI.
Okay, core PCE. And the second one, wage inflation data.
Yes, the Employment Cost Index, or ECI. Economists really like this one. They consider it the cleanest read on wage inflation because it controls for compositional shifts in the workforce. It's not distorted if, say, lots of lower-wage workers get hired or fired. It tracks the cost of labor more purely. These two metrics speak directly to the pressures that could force the Fed to keep policy tight.
So why did this matter so intensely right at this moment?
Because Chair Powell had just given that hawkish warning 2 days before, implying maybe inflation or labor conditions weren't cooling as fast as the market hoped. A hot print, meaning higher than expected, on either the core PCE or the ECI showing sticky price inflation or maybe accelerating wages would definitively validate Powell's caution and validate the dissenters within the FOMC he mentioned.
And the market impact of hot numbers.
It would likely extinguish any remaining hope whatsoever for a December rate cut. That would almost guarantee a highly volatile session, probably send bond yields sharply higher again, and potentially trigger a really severe equity sell-off, especially in tech and growth. The market's immediate path hung entirely on whether those few unpostponed government reports confirmed the systemic risk Powell had hinted at just 48 hours earlier.
So wrapping this up, what does this all mean for you, the listener? Thursday, October 30, 2025. It wasn't just another down day on Wall Street. It felt like a profound shift, really driven by those three interlocking forces we dissected. A Fed determined to temper expectations and raise the cost of capital. A massive, sudden divergence in the AI narrative between spending and earning. And that macroeconomic data void from the shutdown that just amplified all the bad news. The big lesson here seems to be that the cost of success, especially in AI, is finally being recognized by the market.
Yeah, the crucial takeaway, I think, is the aggressive distinguishing the market is now making. It is actively punishing companies that are perceived to be merely spending massively on future AI capabilities, fearing that uncertain, distant payoff timeline. That's the clear message from the reaction to Meta and Microsoft's forward guidance. And conversely, it is overwhelmingly rewarding those companies that are already monetizing that AI infrastructure at scale right now, like Alphabet, like Amazon's AWS. The focus has just decisively shifted from hype and future potential to tangible return on investment, ROI, delivered in the present.
The market seems to have rediscovered the fundamental importance of actual cash flow, of disciplined spending, especially when the cost of capital itself is rising. It really felt like a day where that buy first, figure out the profits later thesis finally collapsed under its own weight, at least for now.
And that brings us to the provocative thought for you, the listener, to maybe mull over as you look towards the next quarter or beyond. That data blackout we discussed, it forced the entire global investment community to rely almost entirely on subjective corporate guidance for its economic conviction. We saw how punishing that was for companies that lacked a clear, profitable monetization story already in place.
So, if the economic trajectory is now being dictated more by the Q&A transcripts of tech giants Meta, Microsoft, Amazon rather than objective, official government statistics simply because those statistics aren't being released, what does that actually mean for global financial stability? How long can markets really tolerate flying blind, relying on corporate narratives instead of objective data, before that uncertainty itself fully caps the potential for reaching new record highs? It raises a really fundamental question, doesn't it? About what data we trust most when the economy starts hitting the brakes.